On Wednesday, the Federal Reserve announced that they'd be increasing interest rates again for the 10th consecutive time in a row, which indicates that although inflation is no longer out of control, it still appears to be a lingering issue that they're hoping to finally squash. With rates already high and now going slightly higher, it's resulted in some businesses feeling more stressed than others. With a lot of the higher yielding holdings that I have in my portfolio, like closed-end funds and business development companies, it's resulted in a mixture of good things like increased net interest income and some bad things like decreasing net asset values on a lot of holdings. But one of my holdings in particular has gotten so beaten up over the last year to the point where it's now offering a dividend yield of over 16%. That's despite some recent statements made by the company's CEO in which he says the company and its dividend are expected to remain steady throughout the remainder of the year and probably going even further than that. But despite this stock's share price falling so much and this company falling on harder times, I'm remaining optimistic about its future. So in today's video, I'm going to discuss the worst performing stock in my portfolio as of right now, and why exactly I'm choosing to stay invested in it. So with that being said, let's go ahead and get started. The company we're going to take a look at is Ares Commercial Real Estate Corporation, ticker ACRE. They're a specialty finance company that originates and invests in commercial real estate loans and related investments. They provide a range of financial solutions for owners, operators, and sponsors of commercial real estate properties. Ares Commercial Real Estate originates senior mortgage loans, subordinated debt, preferred equity products, and other CRE investments. According to their website, it says their goal is to create long-term value for shareholders and favorable investment performance across all economic cycles. There were a handful of reasons that drew me toward this stock in the first place. If you've seen any of my other videos, you'll know that I'm not exactly the biggest fan of mortgage REITs because they tend to see the most dividend cuts out of the other higher yielding types of investments out there like BDCs, closed-end funds, and master limited partnerships. And especially right now in our high interest rate environment, these companies often suffer much more than others, so I never invest large amounts of money into these types of companies. There are a handful of good mortgage REITs out there, but in my opinion, the vast majority of them are either just okay or not very good. But what persuaded me to become an investor in ACRE in the first place was their track record. Not only did this stock have a very high yield, but it also had a very consistent dividend history with no cuts at all. In fact, they actually had some dividend increases in their past, which is pretty unusual to see a lot of these for an M-REIT. I also really like the company that launched this M-REIT, which is Ares Management, who also happen to own my favorite business development company, which is Ares Capital, ticker ARCC. So they've proven themselves to be excellent managers when it comes to this sort of stuff. But this year, ACRE has been my worst performing stock as it's currently down over 27% year to date. It was struggling for a while before this year, and as you can see, it's down nearly 50% from this time a year ago. I started buying this stock when it was trading for around $13 a share, so as of right now, I'm down over 30% with dividends being factored in. The share price of ACRE has fallen so much that this stock now offers a yield of over 16%, even coming close to 17% in dividends right now. This makes it one of the highest yielding stocks in my portfolio right now, and it's currently trading at a massive discount to its NAV by roughly 48%. So why exactly has Ares Commercial Real Estate gotten beaten up so much over the last year? The main issue lies within the commercial real estate market, specifically within the office sector. For over a year, there's been a lot of discussion going around about the possible collapse of the commercial real estate market. There's several reasons why people believe that there could be a possible collapse, with one of the biggest issues having to do with occupancy levels. Over the last 3 years, the number of vacant square feet of office space here in the US has been steadily increasing. The reason for the rise in office vacancies is a combination of more companies allowing people to work from home, as well as more companies now laying people off and using less office space. You can see some of the larger cities like San Francisco, New York, and Austin are currently seeing the worst occupancy ratings. With the economy in the shape that it's currently in, there just aren't as many businesses out there looking to expand into new offices right now. I know a lot of companies are no longer allowing employees to work from home full-time anymore and have instead switched to a hybrid system, but even that still requires less space since not every employee needs a desk every single day. Another reason people are speculating about a collapse are because of current interest rates. It's simply too expensive right now to borrow money, and companies that need to are going to be under a lot of trouble. The reason Ares Commercial Real Estate is down so much compared to other M-REITs that do something very similar is because office property loans make up 38% of this company's investment portfolio. With every new piece of news that comes out regarding the commercial real estate market, people are worrying about this company's future. They're concerned that people who borrow money for office properties from Ares are going to default on their loans because they can't find tenants to rent their offices. There is actually another M-REIT that's currently going through the very same predicament, which is Blackstone Mortgage Trust, ticker BXMT. This M-REIT does basically the exact same thing, and they also hold a lot of office property loans in their portfolio. But during ACRE's latest earnings call, CEO Brian Donahoe gave some really good updates regarding their dividend. He He said on the call, quote, "Even with carrying the strong level of capital, we continue to generate ample cash flow to support our dividend as our loan portfolio benefited from rising short-term interest rates with a weighted average unlevered effect yield of 8.5% and a 300 basis point year-over-year increase. Based on what we see today, and despite the near-term industry headwinds and credit challenges, we expect to be in a position with our run rate earnings power to continue our current level of regular and supplemental cash dividends throughout the remainder of the year." In the same call, the CFO of Ares Commercial Real Estate made this comment, quote, "All of ACRE's funding sources are with leading U.S. banks and insurance companies. ACRE has no direct funding relationships with any regional banks. None of our financing is from spread-based mark-to-market sources." With these statements in mind, it has left me feeling a little better about this company. They also announced during the same call that they've been reducing their exposure to office buildings, which obviously I think is the right move for this company to make. During their latest earnings report, they did not only declare the same base dividend of 33 cents per share, but they also announced a special dividend of 2 cents per share. You can see they've continued to pay this special dividend for several quarters now. If the management wasn't comfortable at all with where they're currently at with their dividends, they would have at least removed the special dividend and just stuck with the base dividend of 33 cents per share. At the same time though, last Wednesday, the company announced that they had experienced 2 loan losses last quarter. One was basically taken care of without any loss to their distributable earnings, but a second loan, which was for a residential property, did result in a loss for the company. To summarize, I think it's pretty obvious that the rest of this year is going to be a difficult trial for this company. Despite some bad news coming in on this company, it does still have positive features to it. It has a great management team behind them, and they have a perfect dividend history of no cuts, and they're slowly moving away from owning so many office property loans. Not to mention 98% of their loans are senior secured, which is the top priority for repayment in case they see any more failures come in. Their NAV has also been slightly decreasing over the last couple quarters, but it hasn't been as bad as some other M-REITs like Annaly Capital. But going forward with ACRE, I don't have any intention of selling any of my shares of this company, especially since I'm so well diversified. The stock only makes up about 3.5% of my overall portfolio, which is why it's always a good idea to diversify your own portfolio. There's no way this company's going to go bankrupt, but even if they did, that would only be about a 3.5% loss of my overall portfolio. So I figure why not just ride things out until things calm down for this company. During the 2008 financial crisis, Ares Capital, which is their BDC, did go through a very difficult situation and they did have to cut their dividend, but they eventually grew it back to where it was. It's a good example of just how good this management team is, and I'm choosing to place my faith in them as they go through this situation. But with that being said, that's going to wrap up today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.